Thank you everyone for joining in. We're just waiting for others to join and then we'll explain a few things before we formally start the session. We're going to give it 2 more minutes for everyone else to join in. And as I said earlier, we'll explain a few things and then we'll formally start the session and go live on Facebook as well.
Zubair, do you spend so much time wired in that like wireless just don't have enough battery? Is that why you use wired?
No, I actually prefer wired earphones over
Okay.
using the wireless ones. I actually don't have completely wireless ones. I have those that you hang around your neck and then
Yeah.
plug into your ears. I prefer these over them. And
Yeah.
all my phones have, phones and phone and laptop have headphone jacks until now.
Yeah.
So it's a lot easier.
Yeah.
Don't use an iPhone. I think it would have made a lot more sense
Yeah.
if I had an iPhone. I think we're going to hit live in a minute. So let me just explain this for all of you who are here. First of all, thank you so much for joining in for the second session of VC101 by MENAbytes and Modus Capital. Thank you, Kareem, for taking the time again today to join us and walk us through these more details on how to raise an investment, how to be investment ready in the Middle East and North Africa for early stage startups. We're so after receiving some feedback from the first session, we're making a few small changes for how this session would be run. We're still going to stream it live on Facebook because that's what we had told the audience, told our readers at the launch of the bootcamp. So we're going to do that, but to encourage more participation from those who have been selected to attend this on Zoom, because this is primarily for you and everyone else who watches. This is sort of, it serves them as well, but this boot camp is primarily designed and delivered, has been designed and it is being delivered for you guys. So for those of you who have questions, whenever you have a question, you can use raise hand feature on your Zoom, and then you will be allowed to talk. So, and when you are given this opportunity to talk, you can use your microphone to ask your questions, any question that you may have around what we're going to discuss today. And Kareem is going to use some slides, but at the end of every slide, there will be an opportunity for everyone on Zoom to ask questions. And then towards the end of the program, there will be these 30 minutes also dedicated for a dedicated Q&A where you can ask, any questions that you may have around venture capital. For at the end of every topic, when Kareem is done explaining it through the slides, please ask questions that are relevant to that particular topic only. Towards the end of the session, you can obviously ask questions around anything that has to do with venture capital. please use the raise hand feature, and whenever you have a question, and we'll try to give as many people the opportunity to ask questions as possible during the session. So we're going to hit live on Facebook, and then we'll just start the session. And we're live on Facebook. Thank you so much, everyone, for joining in. Welcome to the second session of VC101 by MENAbytes and Modus Capital. In this online bootcamp, we're trying to help founders learn everything around the basics of raising venture capital in the Middle East, North Africa, Turkey, and Pakistan. In this second session, Kareem is going to walk us through some of the details around how VCs like to think about startups. He's going to talk about how VCs in the Middle East and North Africa are different than those in the Silicon Valley. He's going to talk about what kind of homework should founders do before reaching out to potential investors, and how do founders find the right investors. He's going to also talk about things founders should keep in mind when they are doing their first call or meeting with the investors, and also what makes VCs invest in startups. Thank you so much, Kareem, for joining in for this second session. Pleasure to have you here.
Awesome. Thanks, Zubair. Thanks for having me. Always a pleasure, and hope we can go over some exciting stuff today.
Yeah. You have the slides ready?
Yeah. So let's start. Give me 1 second here. All right. So let me know when you can see my screen. Yeah. Good. All right. You're on mute, but
yeah.
All right. Give me a second here. All right, so what we're essentially going to be doing is continuing with like an investor lens. This is essentially how what investors kind of look for, but we're also going to reference a lot what the entrepreneur should be looking for as well. So the first thing that we're going to talk about is the differences in VCs, right? MENA, Turkey, and Pakistan, I'm a lot more oriented with MENA, but it's very, very different from Silicon Valley, very different from the West. And I've outlined just a couple of things for us to go over here. So the thing that you can see right off the top that is shared across the two is the LPs, right? LPs, you have to understand that LPs essentially drive what the venture fund is going to be doing. And how that happens is that the venture fund has an investment thesis, and then the LPs buy into that investment thesis, right? So if you, for example, in the Middle East, let's say you're in an emerging market like Egypt, for example, right? And some of your major LPs are DFIs, developmental finance institutions like IFC, World Bank, European Bank for Reconstruction, Development, et cetera. They're going to have kind of a different type of view or a different type of strategy for how they want you to be able to invest. So there's going to be a local development and impact type of angle that they're going to want, that's going to be kind of like core to your thesis, right? versus in the Valley, right, your LPs may be more just purely financially driven, right? They may want, you know, again, they're looking for much higher, much better returns. So that's one of the main things that you kind of have to like look at and consider, right? Is the LP construction. What are those LPs looking for, and in turn, what is it that the VC as an investment thesis actually has? A second thing, and this other point that you can see there that is also shared across the two is in the Valley, you know, it's about grow now, money later. And I'm sure you guys have seen, I would say, a lot of backlash against that type of growth strategy, right? The concept that grow at all costs, right? Don't worry about unit economics. Don't worry about revenue. Don't worry about profits, and that you'll be able to essentially monetize in a myriad of ways and down the road. That's really a Western VC type of mentality, right? They know that they'll be able to monetize in some way, shape, or form. Now, we've seen a lot of backlash with that. Consider Uber, consider the most recent one, WeWork, right? Like tons and tons of backlash on that. And you've actually seen this in the public markets where you have a lot of companies that were going to IPO, but then actually prevented or didn't IPO because they don't think that they need to get their house in order better and have stronger numbers, focusing more on profits than just to IPO to be able to raise additional capital. In MENA, it's very different, right? Investors, you have a different type of investor, right? You're talking about traditional industries like real estate, factory, like LPs that like to touch and feel, right? So what that does is that actually reverberates to the VC, right? VCs may want to see more money driven or revenue driven kind of growth than just, you know, than user growth, right? Or to other different types of transactional growth, actual monetary growth. So that's something that is a pretty big distinguisher. Again, in the Middle East, you're going to find VCs are going to look more. They do consider obviously grow now and being able to monetize, because not all companies are monetizing from the beginning, right? But you're going to see a higher pressure and a bigger demand for companies to turn a profit or to at least be self-sustainable a lot quicker than, you know, a Series D or later, right? Round as you would out west. Another point, competition, right? In the US and in the Valley, the space is very, very competitive, right? Like VCs fight each other to be able to get into deals, right? And that's because there's an abundance of capital, right? And there's also like an abundance of innovation, but there's enough supply and demand to where that the demand for companies are getting into good deals, it gets super, super competitive, right? And people are extremely secretive. Now, it is the same way here as well, but here, because the ecosystem is very early, you find more of like a communal, like club type of approach, right? Where, okay, here's a good company. What we actually want to do is we want to give this company the best option for success, or the best optionality for success. So what we want to do is we want to make sure that they're well funded, right? And if a company, you know, and in doing that, VCs kind of like collaborate together in investing in deals, right? Is there a little bit of competition? Yeah, of course there is. VCs want to be able to get the best terms, and they want to be able to get as much of a good high growth, high opportunity company as possible. So there still is a component of that exists, but it's nothing like the way it is out west. Okay, now in the West, again, like the differences, everything there is kind of on an innovative edge, right? It's what is the distinguishing factor between a company, right? You can have a company that does the same thing as 3 or 4 other companies, but it's simply differentiated by the way the UI or the UX is, right? Or their monetization model, right? Like you're literally like always on the cusp of that one differentiator, right? That makes you innovative, right? And that's what I mean by innovative edge. Here in MENA, again, a little bit different. It's greenfield, right? There's lots of opportunity. You can literally, and you see this a lot of, I don't want to say like copycat models, but a lot of like, let's look at models that work in other markets. Let's see what their applicability to be able to work here is, and then be able to set them up. So I'm not saying that people aren't innovative here. It takes a whole different level of innovation to be able to even make something that works somewhere else to make it work here, right? You have to be innovative. So there is definitely tons and tons of innovation, but it's different types of innovation, right? It's not like cutting edge, like, and there still is cutting edge like market innovation, but you see innovation in how business models work, how growth strategies are, how the product is actually deployed, or how it actually is executed. You see a lot more innovation that way. And then also VCs in the valley, they all obviously operate by portfolio asset value, right? Their goal is to, let's build a portfolio, let's get some high winning companies in this portfolio that increases the asset value of the portfolio. And during their deployment period, when they deploy, let's say they have $100 million fund, and they can begin raising on their next fund, their second fund, when they deploy 75% of their capital. They deploy $75 million, they may necessarily not have gotten all of their returns yet, but the asset value of the fund is their credibility into being able to raise a second fund, because they've made good decisions. The companies that they've invested in have increased in value over that time, which again increases the asset value of the entire portfolio. And then they go and they raise off of that. In the Middle East, again, it's fairly early, but it's more of like portfolio. There is obviously the same concept of the portfolio asset value, but then there's also like an impact perspective as well, right? Like what is like more of like, what are the and again, this comes from like the kind of like ecosystem development standpoint. What are the number of employees that were created, that jobs that were created, right? What is the local impact on the economy, right? And then again, that kind of links back to the LPs and what is kind of like driving the LPs. So you have a question, Zubair?
Yes, sure. I have a few. So do you want to turn off the slide, the screen sharing for now? Yeah. So I agree with the part that, a lot of LPs in the region have impact as, part of their thesis. But when we talk about these LPs, don't you think that they are very few, and most of the funds that are being deployed are actually being deployed to be able to make money out of those deals at the end of the day? And also, when we consider this, that there are large government funds at play here in Saudi, in UAE, that are trying to promote local ecosystems in these specific markets. How does all of that fit into the picture, especially considering that, the region is completely fragmented, and if you as a VC in Saudi have a mandate to invest in Saudi, and you come across a good deal in Egypt, what do you do?
Yeah, so it's a really good question. So look, nobody's investing in VCs as a charity, right?
Right. Yeah.
Everybody expects a return, right? There are other programs that are set up like that, right? There's like government accelerators and grants which don't take equity, for example, but they give you, there's a budget for resources, or they give you essentially small financial grants to be able to grow. So 100%, there is definitely from all LPs a return interest component, 100%. But even the ones that are looking for returns right now, they all understand that there is a responsibility, or there is also, they have a drive, a portion of their drive is to develop the local ecosystem. If you're talking about, let's say, family offices, right, that are investing, yes, they absolutely want a return, but at the same time, these family offices know that they want the betterment of the local ecosystem, of the local economy, right? It's still something in the back of their mind. Now, what percentage is the impact compared to returns? It varies with everybody, right? But it's definitely something that is a more primary focus in the MENA region because it's still developing than it is out west. There are some funds in the US that focus on specific areas in the country that are developmental focused, right? So being able to create jobs in certain areas, And so that does exist, but it's a minority, right? Whereas here you find that the impact component is definitely a big part of it. Now, to your second question about the governments, right? How would a VC be? How would they invest essentially if there's a mandate for them to deploy most of their capital in Saudi? Like, look, I think the conversation that is had is it's a fragmented market, right? Saudi is different from the rest of the GCC, which is totally different from Egypt, but there's enough similarities to where a company in Egypt wants to be able to expand into the GCC and into Saudi and vice versa, right? And I've actually think that in the past year, you've been seeing a lot more focus on that and a lot more openness to it, right? The understanding that, hey, this money needs to be allocated to Saudi companies, but maybe what it is, it's an Egyptian company that's going to set up a local Saudi entity to be able to enter Saudi. And what you do is you invest into it that way, right? So there's different ways around it.
Right, sure. And when we talk about competition, you mentioned in your slides as well that, in Silicon Valley, this is very normal that investors would fight to get into a deal, and the good deals usually close very soon without even without even their founders going to a large number of VCs and trying to raise funds. They close in days sometimes, especially at pre-seed and seed stage. Now, we are obviously starting to see this happen in the region at a very small scale, maybe right now. But when you talk about this, what do you think? I mean, how long would we take to get to a point where perhaps the equilibrium shifts towards founders? It is already happening to some extent, but how long do you think we would need to actually get to a point where this will become a norm, where VCs would have to actually fight to get into a good deal in the region? And from your perspective, being an investor in the region, how often do you see this happening in the region at the moment?
So how often? I don't see it happening very frequently. I would say maybe like one in like 15, 20, maybe even more deals. I don't think there's enough really data for me to be able to kind of like accurately quote, but it happens, right? And when does it happen? This will kind of help answer your first question. You see it happening when entrepreneurs like focus less on fundraising and more on the core business, and are just super innovative and really just roll up their sleeve, put their head down, and just like do work, right? The companies that do that, and the people that are the most resourceful, and the entrepreneurs that are the most resourceful and the most creative, figure out ways to be able to be self-sustainable very early, right? And because they're self-sustainable and they can sustain not just regular operations, but also be able to sustain a high rate of growth, right? Without taking outside capital, those become the ones that are super, super attractive, and people will be fighting to get in on those deals. So, how long will it take? I can't really put a number on it, but I'll tell you some of the indicators, right? More resourceful, more experienced, essentially, founders, right? Founders that have gone through the cycle 2, 3, 4 times, right? Because they're going to be the ones that have gone through it, and they're going to be the ones that can be the most resourceful, the most capital efficient, the ones that can take incremental approach to where they say, okay, we're going to do this just to bring in revenue for the next 12 months, and that'll fund us for another year and a half. And in that year and a half, we'll be able to get this incremental growth, et cetera. So I think that's what you need to have. You need to have like a critical mass of entrepreneurs that are able to create companies like that, essentially like literally bootstrapped until they're like getting really high growth, right? For companies to be able to, or for VCs to be able to kind of fight. The other thing is that you also are going to require, obviously, like basic supply and demand. You're going to require less investors to be in the region, which nobody wants, right? The less investors, the more competition that you're going to have amongst them to try to get in on deals, right? So.
Right, sure. Let's move on to the next slide if we can.
Sure.
Thank you, Kareem.
All right. So, so this is talking about, what is a good fit for the VCs, right? You got to research, right? And I don't know if I'm sure you've heard this quote. It was in Sherlock Holmes, right? Like data, can't make bricks without clay, man. And it's really what it's all about. It's all about the data. So how do you know it's going to be a good fit for them, right? Research their portfolios, talk to portfolio company founders. It was something that we mentioned before. Look in their portfolios and see where there's overlap, right? You may be getting into a company, you may be trying to target an investor that has a similar company, but maybe there's enough differentiation to where it makes sense, right? Or maybe, and this goes to like risk mitigation, maybe what you have is you have some VCs who invest into 2 companies or more, right, that are in an industry, right? Even though they're the same industry, it may be a de-risking method, right? It may be that the 2 companies are targeting currently 2 different segments, and they think that one of them can be a champion or both of them can be fairly big, right? Kind of like owning their own segments. So being able to look again into the portfolio companies and seeing where there is overlap, if they have a company in there. And the reason why I say this is because we've been approached by a company that, had they done their research, they would have seen that we had a 100% direct competitor with them and it wasn't even like it was so clear, right? So it's definitely something to do, right? Some of the other things, right? The basics, right? Like what industry are they in? What stage do they invest in? Ticket size, right? Stage and ticket size are actually 2 different things. Some people like to get into A rounds, but they write small tickets, right? Some people like to do seed rounds, but they do big tickets. So that's really, really important. And also understanding like if they like to lead or they like to follow, right? A lot of investors in the region are, they like to follow because there's not a lot of VCs that have, I would say that, or they're still kind of building the depth of experience to be able to like lead on rounds, whether it's valuation, whether it's due diligence, right? And actually going through and doing the market research and essentially having a company fully vetted. But again, that's something that's super critical for you as a founder to be able to look at, right? And then another thing that I think a lot of people don't really consider is, and you find this more in more mature markets, but I think it's something to consider here is the structure, right? Like equity is not the only way to raise capital, right? If you are a business and you require machinery or some sort of like devices, like debt may be a good product for you. Equity is expensive. It's the most expensive thing that you have, right? If you can do debt financing, great, right? And there's also a hybrid, right? There's a hybrid where you can give up a little bit of equity, you have a little bit of debt, and it's kind of like a blended deal. And again, you see this in more kind of like mature markets because you need different creative ways of financing. Investors understand a little bit more, they have a little bit deeper experience and can actually put things together like that. But it's not to say that it doesn't actually happen here, but you definitely do see it. I'm sure it does happen here, but most of the VCs traditionally here, they're more primarily just like equity based.
I've always,
I
tried.
think you're on mute, Zubair.
Can you hear me now? I think, do you hear me?
Nope, can't hear you.
Do you hear me now?
Oh, I think it's me.
Okay.
Okay, now I can hear you, sorry.
Yeah. So we have, I think, a question from the attendee as well. I'll take that in a minute. But I've always tried to, I've always wondered this. When I go to website of a VC firm, I'm not talking about the region in particular. I'm talking about, generally speaking, there is very little information there about the startups that they want to invest in. There are very few firms in the region or even beyond that make it very clear on their website about the startups that they want to invest in. Why do they do this? Is this designed on by purpose, or is there something else behind this? And why is it so difficult for VCs to put this all on a page and put it up on their website, explaining these are the startups that they want to invest in. This type of startup is something that they would be interested to invest in.
It's a good question. I mean, I can't speak for everybody, but I mean, I would assume that if you're a VC, you've got lots of people coming to you, and I think it's in your best interest to identify specifically, right? But I think it's also about, a part of it is about opportunity, right? I think a lot of VCs are opportunistic. So the ones that you find are like super niche or focus on a very specific industry or stage or something like that are going to identify that, right? They're going to say, we only do this, right? But the ones that are more opportunistic, that are a little bit more industry or stage agnostic, like they'll kind of like leave it open-ended. I think the other thing is because they may feel like they don't need to. They have, I don't think that they really build a lot of deal flow. They don't build their deal flow from their website, right? I think it's primarily through venture partner networks, through other connections, through other partnerships, or knowing founders, right? I think that could be another reason.
Right. And when a founder is trying to research, trying to understand if this particular investor could be a fit for them, and if their startup could be a fit for this investor, where else should they go apart from their website, which is obviously, which is an obvious thing to do.
Yeah. Look at the founders, see, look at their experience on LinkedIn, see what industries that they've worked in, right? Not just invested, but like worked in. If a founder invested or a partner invested in or worked in a specific industry, they're probably more akin to invest in that industry, right? That might tell you something about it. Look and see if they have any blogs, either as a VC or as an individual, right? Sometimes they like to share their thoughts about why they invested in companies, which will help shed some light on how they think, right? Other simple things like Twitter, right? See what they're tracking, see what they're following, see what their remarks are on news for other things, right? If you see a partner in a VC saying something about WeWork, like, I can't believe investors are investing in this type of model, that's probably, what he thinks about that industry, right? Or that business model, at least, right? So there's a lot of things, there's a lot of different ways. You just got to be kind of like crafty and resourceful, right? Like follow the breadcrumbs, follow the trails, again, around the individuals that are kind of like working there, around the companies, if they have portfolio companies, like just research their portfolio companies. It'll tell a lot. It'll really will tell a lot.
Right. We have a question from the audience. Please go ahead. You have the microphone. You can unmute yourself and ask the question. Okay, I think we can perhaps have him later. Kareem, let's move on to the next slide.
Sure. All right, so this is if it's a fit for you, right? You got to understand that just because, again, VCs or investors have money, like you also have a say in it, right? Doesn't mean that you have to just take everybody, right? So understand your worth. Capital is necessary, but don't be its slave, right? And that's something it's, as a founder, it's like really, really important. Like we get it, you need the money. You feel like the money may alleviate a lot of pain. I can argue also that it can just make things worse, right? If you have money and you're not really like organized and you get more money, you're just gonna have a bigger mess than your small mess, right? So some of the things to consider, right? If an investor is gonna be passive or active, right? Passive investor, again, means somebody who's going to invest. They're gonna wanna get quarterly updates from you and that's just about it. Or an active investor who is going to kind of like do some hand holding, be a lot more engaged with you. And if they are going to be an active investor, they can be an active investor that can be problematic for you, or they can be value added, right? Like I know that a lot of entrepreneurs have had experiences, where they get an investor and that investor really just may make things a little bit too challenging, right? For them to be able to focus on what they need to focus on. If they are going to be active, think about what is their value added, right? Are they going to be in a specific industry? And then this goes into the next point, the strategic investor considerations, right? Are they a good operator? Are they going to help you set up a corporate sales structure, right? Are they going to be value added in the ability to provide you follow-on funding, right? So somebody that you know is an anchor, somebody who may be able to get you industry access, right? An early adopter, first client, right? That might be a corporate or a small business or whatever the case may be. And then also think exit strategy, right? You may want to exit to one of your investors. If one of your investors is a bank, right? And you're a fintech, and these guys invest in you, and you have a really awesome platform that gets customers or gets other banking clients, or it's a integral, like, kind of back end type of technology, or technology that is very valuable to the intra-org operations of the company or the bank, might be a good exit opportunity. Or somebody who may be able to help facilitate an exit, right, for you. Somebody who, again, if there's somebody who's in an industry, in the same industry, they may know of a larger corporation that may want to acquire you, right, just as an exit strategy. So just some things to understand there. You also have to kind of like look inside, and you have to just identify that, like, you also have a say in the matter, and see, and it's like dating, right? It goes both ways. You know, you kind of have to see, like, what is it that is good for you as well. It's not just about what is good for the investor. And I think actually, like, a good exercise is to do this first, right? Try to understand, like, what is it that you want, right? And let's just talk about it from a strategy perspective. Let's say you want to raise $1 million, right? Do you want to have, 20 investors at $50,000? Like, that's a lot of investors to deal with, right? Maybe you want bigger tickets, right? And bigger tickets will tell you that, okay, maybe I just want 4 investors. And then that's going to identify that you have a target of 250K, right? And now you can go and you can start targeting VCs that invest 250K, not more, not less, right? So I think a good place to start is like inward facing. Think about what it is that you want, what can be a strategic value add, what is it that you want from an investor, and put that stuff together, right, as like an ideal investor profile for you, and then begin going out and researching them.
Right. When you're unable to find a lead, and as you mentioned that, in the Middle East and North Africa, a lot of investors actually try to follow instead of coming in as a lead. And this is something that I've heard from founders too. And some of founders have explained to me how they have struggled many times to find a lead investor. What do you do when you have these soft commitments from a lot of investors, but nobody is willing to lead? What do you do in this case?
So there's a couple things you can do. One is you can do a bridge, right? To try to, if somebody's not leading, it may be because you have a potential lead, but so talk to the ones that may consider leading. Understand why it is that they're not leading the round. Maybe you're too early. Maybe there's something that you can work towards, right? If it's something you can work towards, it may make sense for you to like raise a bridge to be able to, a bridge to be able to get to that threshold into where you qualify for them to be able to look at you at a lead. So, and that's just very simple of just like asking feedback, right? If that's not the case, try to incentivize some of your existing investors, right? Like, why do investors want to follow is because a lead investor assumes a lot of the heavy lifting on determining a valuation or setting the initial terms or doing the due diligence, right? And if you can talk to, or if you can make one of your soft commitment investors comfortable, right, to where they feel like, okay, like, I understand this may take a little bit of hand holding, may take a little bit more effort on your part, but if they get that type of a comfort, you can essentially nudge them into actually being able to lead. And that might come in the form of, again, like supporting them in making them understand, making them feel safe, or maybe it's even giving some preferential terms in some way, right? Giving them, hey, if you lead, we will give you a discount, right? Something like that, right?
Right. And let's just say you talked about, active investors, and you said that it could go both ways. There could be active investors who are trying to actually help you, and there could be some who are perhaps trying to micromanage even a startup in a way. So let's just say that you end up having somebody on your cap table that you realize after a few months is not an ideal fit. What do you do in that case? Can you actually get them off your cap table, or what's done is done?
So it depends on the terms, right? Like if you have if you have the ability to buy back, right, and there's a buyback clause and there's a multiple that they can get, you may be able to. I think the first thing is to have a conversation with them. But if there's something in your in your agreement that allows you to be able to buy back and you haven't spent that money, you can talk to them and just say, hey, look, like, I think that this relationship is going to be challenging for the both of us. I think it makes sense for us to, we'd love to, give you your money back and no harm done and can continue going on. That's the first thing you can do. The second thing you can do is you can go to your other LPs and just say that, explain some of the challenges that you're having and just say that, you think that it's a little bit too challenging and that it's making things a little bit more difficult. And maybe one of your LPs will step in and be able to buy them out, right? Give them
investors, not LPs.
I'm sorry, investors. I apologize.
Yeah.
I'm on the other side of the table, right?
Yeah.
So I'm dealing with LPs all the time. So yeah, you can go to your investors and have one of your investors be able to buy them out. The other thing you can do, is just people management. Try to set up a good workflow where you're getting what you need. You're making sure that investor is comfortable, and maybe in the next round, what you do is while you're fundraising for the next round, again, you have some new outside capital go in to try to buy them out, and they can buy them out at a higher valuation. And, you can say, hey, look, you're going to get a good return. You're going to get a 2x return versus continuing with us in the risk, and maybe be able to get them off the cap table that way.
Right. And if I'm an early stage founder, I'm starting to raise my first round, what's the ideal, I know it would depend on a lot of things, but generally speaking, who would be an ideal fit for me? Do I raise this $500,000 from one single investor, or do I try to get at least 2-3 investors on my cap table if they're adding value?
If they're adding value, definitely try to get, and again, this was about profiling investors. If they're adding value, definitely bring them in. To a degree, you don't want to have 5 investors or 7 investors, be cautious of that. If they're providing value, just do a cost benefit analysis. Okay, the cost of me having to manage an additional investor is X, but the benefit that I'm going to get from having them in strategically is great. It also may be different type of value, right? They could be a passive investor, but they can be an institutional investor, and the brand of that institutional investor as a passive investor is valuable for you in your future fundraising, right? So it's not just about them being active, right? They can have passive value added as well, right? Through brand association. General rule, I like to recommend the less investors that you have to deal with, the easier it is, right? It's like a democracy. Like, more votes that you have, the more you're going to have like conflicting opinions or thoughts, and it's just easier to manage smaller number of investors.
Right. What's the cost of having more investors on your cap table? If they don't have a board seat, what is it that that could become a problem, or where are you spending the money to manage them then?
It's even if they're not on the board, it depends, right? They still may want updates from you. They still may be engaging with you in different ways. And the other thing is also not attractive for investors down the road. If you've
Right.
raised $500,000 and you have 11 people on your cap table, it's kind of a messy cap table, right? Like, future investors are like, there's a lot of people. There's somebody in there who's got like $7,000, like why, So it's also not really like a good look for future investors.
Right. Thank you, Kareem. Let's move to the next slide.
Sure. All right. So now we're talking about etiquette. So I'd like to ask this question to the people who are kind of like viewing this right now. Who's your best friend that works with an investor every single day, right? I think this is kind of like, and there's a hint in the slide, right?
I don't think we're going to get a lot of answers, but yeah, I can imagine some of them.
It's the gatekeeper, right?
Yeah.
Every investor has a gatekeeper. And it's all about building rapport, right? Like, you know, you're selling yourself, you're selling your founding team, you're selling value, right? But like when it comes to the personal side and the etiquette side, right? Like you want to make sure that you're building rapport. And again, one of the things that's highly overlooked is the person who is with an investor every single day is their executive assistant. There are countless times that I have been fundraising where the executive assistant of one of my LPs or one of my investors was a core reason or a core driving factor in us actually getting the investment. And it's something as simple as like sending a thank you card, but like what I have an LP that I chased for a year and a half, and I had such a good rapport with his executive assistant that she used to tell me he's actually going to be back in town this week. So email him and ask him if he may have availability on this Thursday around lunch, because I know that his schedule is open, right? So that's something really, really important. Don't devalue that at all, right? Another things that are considerate, right? Like that you need to consider, right? Like the culture, right? Time, always make sure you're on time, right? The time of the investor, make sure that you are very cognizant of their time, understand that their time is valuable, as is your time as well. And then going to like formalities or lack thereof, right? In the Middle East, for example, versus the West here, you need to make an appointment with somebody. You need to be on time. You need to be understanding that they very well may be 10, 15, 30 minutes late to the meeting, right? Because that's the way it is in the region. And you also need to give some consideration that you're probably going to sit and drink coffee or tea, talk about family, the environment, the weather. You're going to talk about something, right? Before you kind of like dive into it, right? Whereas etiquette in New York, for example, is from the minute you get into that meeting room, you need to be talking about like the pertinent facts, like what is important. You just go in, like that's the formality there, right? Like you just got to like dive right into it. So with etiquette, right? Like try to think about these things, try to think about the things on the periphery, right? That actually matter. A lot of people don't really give this its due consideration. It makes it, I don't want to say it makes it challenging, but it doesn't make it easier. And you can make it a lot easier on yourself when you're fundraising if you actually consider some of these etiquette components.
In the region, uh, is it a normal practice that VCs have executive assistants, or you go through an investment associate?
Investment associate, sometimes they also have executive assistants. I think it's both. But even the executive assistant will usually also sometimes support the associates.
And executive assistants can be of help, like you said. They can perhaps guide you about the schedule and all those things. But when it comes to actually landing an investment, the word of obviously an investment associate or somebody who closely works with the investor on investments is way more valuable than of somebody who's working as an executive assistant at a firm.
Sure, but then they may be the primary gatekeeper, right?
Right.
The gatekeeper doesn't mean the executive assistant. I'm just saying, like,
Yes,
executive as an
absolutely. Yeah.
example. If it's an associate, it may be the associate, right? And again, like, if you work with an associate in a way where he understands that you think out of the box, you take feedback, right? That you're open, that you're respectful. These are all things that are going to help him drive. Say, you know what? Like, they give me a good vibe. I like these people, right? You always hear investors saying, we invest in people, right? These are the components of what they're actually investing in. These are the attributes that lead them to say, I want to invest in, because of the personal aspect. These are the things that lead them to say that I want to invest in this person.
Right. Thank you. Let's move on to the next slide. Okay.
Sure. All right. So next is ease of access. What's the most valuable thing for an investor, right? It's the most valuable commodity for anyone. It's time, right? It's something that you never get back, right? So in you trying to make sure that you are accommodating to an investor, to them and their team, make sure that you have some flexibility in your time, right? Understand that they're busy, respect their time. Again, don't be late. Make sure again that if there's if there's a way that you can help facilitate something for them, make sure to do that. What are some of the things that you can do to provide ease of access? Is be organized, right? Be organized in your communication. Be like very, very clear, right? Try not to beat around the bush and just be very, very direct. Hey, we're here. This is our timeline. This is what we're looking for, et cetera. And you do it obviously in a very friendly and professional way. The other thing, and I would say is probably the biggest thing, is DD, your due diligence, right? No analyst or investor or anyone on an investor team wants to have to drag and pull information, due diligence information from you, right? And you see this all the time, right? It's a email thread of 60, 70, 80 emails, right? Where we're asking for A, B, C, all the way to Z, right? And then we're going all the way back to A. Versus if you have a data room, the data room is organized, everything is in a folder. And what you do is you just shoot off a link to the investor or their associate or whoever's running point, and everything's there and it's organized, and it's very, very easy to access. This is something that I think a lot of people don't really think about or consider, right? You want to make sure that your data room is, again, super clean, super organized, very easy to access. And again, it's part of that being organized.
When we talk about due diligence, I know we're going to discuss this in detail in one of the upcoming sessions, but if you can quickly tell the viewers about some of the most basic documents that investors request when they are going through due diligence of a startup, especially in the region in context of Middle East and North Africa.
Sure. So some of the things is, where are you incorporated, right? What jurisdiction is the company set up, the corporation, corporate structure, parent company or subsidiaries, any contracts between key personnel, contracts between founders or contracts between key employees, cap table, obviously, who owns what percentage of what, and who those people are and where, how are people incentivized. Financial statements and financial records, something that's super critical as well. And then there's, depending on the industry you're in, there may be some DD around the product, right? Like if it's heavy tech, they may want to see like a product, like an architecture schema, something like that. They may want to dig in and do technical due diligence. Any marketing and analytics, customer acquisition stuff is critical. And then obviously like your financial model, right? Like what you've spent money on in the past, what your projections are, your capital allocation for operational expenses, et cetera. What does that look like? Where's the money going to be spent? So these are just some of the basic things.
Right. And you being an investor who has invested in the region, what are some of the common mistakes that you see founders making while they are sharing these due diligence documents with investors, apart from, delaying the stuff?
Yeah, I think, again, them not being organized and in a way where you can easily like go through it, which just makes our life so much easier, right? And the easier it is for us, the more we can focus on what really matters, not organizing and shuffling through documents. I think financial models are key. I think a lot of people really miss that. And, Simon, the principal at Modus, had actually posted a blog article, is posting a series of blog posts about that, about how to properly put together a financial model. In the financial models, projections, right? Some people have everybody's got this hockey stick growth curve, right? Like showing in their financial models, and it's a lot more work than just putting in numbers, right? So I think those are some of the main mistakes. I think something also that not a lot of people put in is customer testimonials, something that identifies like customer experience, right? Because in the end, you're fundraising for a startup. This startup should be solving a problem or have a very high value utility, right? And the best street credit that you're going to have from that is literally on the street from your customers. And if you don't have something, whether it's a survey or whether it's feedback or something that indicates customers' feedback, that's something that we see get missed a lot. One of the things that we do is we say, hey, on our DD checklist, we want to call some of your customers. We want to ask them about the experience, about the product. How has it helped their lives? How has it changed their lives, whether you're a business or an individual? It's like this is the on the ground proof that what you're doing really works and is sustainable.
Right. And when we talk about financial projections, what I keep hearing, from a lot of people that I speak with is that you can never have, a close to accurate financial projections when you're an early stage startup. No matter what you put there, it is, going to be wrong, either this way or, the other way. So what's the point of putting them in if, what you're going to put in it is going to be, not right at the end of the day anyway?
I'll tell you. So if you're talking about returns, right, and like revenues, for example, and so first of all, it serves a purpose for the first. Okay, it's not going to be accurate after, let's say, depending on how early you are, maybe it won't be accurate after a year. Maybe it's accurate up to 2 years, right? But you have 5-year projections, right? But at least it gives you a guide for what is realistic in that first year or two, right? Maybe it won't be your 3, 4, and 5 become less and less accurate, right? So that's one. And in that, it's really the capital allocation. Where are we seeing, if you are a direct-to-consumer brand, but you're only spending 3% of the money you're raising on marketing, there's a red flag, right? So it serves to give you context of how the company is preparing to actually operate. Now, we know there's going to be variances within that, right? But at least it's a baseline. So that's one. The other thing is it tells you, it tells the investor, like, what are some of the options that you have as as revenue streams, right? So in your financial model, there could be, it could be, if it's a SaaS subscription, you can be gaming out 3 different types of subscription levels, for example, right? And you're letting the investor know that there are different monetization strategies that you guys are actually thinking about, right? And in the model is one, right? But you can also have a second and a third that you're going to test and do some price testing and iterate on in the future. So it does provide a lot of valuable information, even though it's not going to be, super accurate, right, past a certain period of time.
Right. And is this a good idea to share 2, 3 scenarios, a pessimistic and optimistic, and something that's average with investors in terms of financial forecast?
Look, under promise, over deliver. That's always my say, right? It's the best approach. You're going to get so much more credibility, and you're going to have, you're going to feel better about it when you over deliver, right? Your investors are going to feel great about it. I think giving, you shouldn't give a couple of scenarios as your core, but what you should give something like initially something that's realistic, right? Something that is achievable, something that sets a very realistic achievable milestone for you.
Right. Let's move on to the next slide. Thank you, Kareem.
Sure. Yeah. All right. So next is getting to yes, right? How do you, what makes investors, essentially get to the point of investing, right? One thing to know is for every yes, you're going to hear a whole lot of no's, right? That's just the law of averages, right? If you talk to 100 people, 25 will be interested. Of those 25, 10 will be taken seriously, and of those 10, you may be able to get 3 or 4, right? So don't be discouraged, right? Some of the things to consider: are you articulate? Are you articulating your value proposition, your team, your value, what it is that you're trying to do, very, very clearly, right? Are you organized, right? And I think we talked about this quite a bit. Are you focused, right? Or are you can't be coming in and saying, we're going to do telemedicine, and we're going to do pharmacy, and we're going to do, last mile delivery, and that's a very, very broad, those are 3 different startups in themselves, right? So making sure that you're focused, and because this is a big thing for investors, is they want to make sure that if you have a finite amount of money, right? And if you're diluting $1 million on what really should be 3 different startups, right? You're being extremely inefficient with your capital. So making sure you're focused is key. Well prepared, right? Understanding what it is that you're going to need, right? And this is again where the financial model plays an integral role in that, right? Again, do you have a clear plan? Do you know your limits, right? What are you good at? What are you not good at? It's there's nothing wrong with saying that I am an operational CEO and I don't know anything about tech, but I'm going to bring on a CTO who's going to be a rock star and he's going to make the tech very, very good, right? Like understand your limits and just be humble, right? Don't try to present to investors that you've got it all figured out. Like you don't have it all figured out, right? Like you've got something figured out. This is the whole nature of venture, right? It's early, you have a little bit of traction, right? Or a little bit more than a little bit of traction, and you're working towards figuring out what does this mean, right? So understand that. Understand value, right? Understand the value internally as an organization, value your team, understand that these are the people who are going to be making this successful. No one founder ever made a company by himself. It's always a team, and value your team and treat them accordingly, right? They're the ones who are actually going to make this happen. Understand the value of your customers and understand the value of, for sure, your customers, and understand the value of your product, right? Make sure that you consistently are looking at, and is this product creating value for my customers? And how much do I really value these different types of customers? And do you have realistic expectations? Again, we talked about that, like under promise, over deliver. Don't try to be, don't try to take on too much. Don't try to show that you're going to be like super hyper growth in like 6 months. Like, again, just be realistic, right? Investors, it's a really, really big red flag for investors. Some shared considerations. Again, this is something across all VCs are going to look at, right? First and foremost is the economic opportunity, their ability to make money. Again, remember we talked about this in the first session. A VC is, their job is to make a multiple return, a higher multiple return as possible for their LPs, right? Team, right? They're the value creators again. So they're all going to look at the team. They're going to say, are they good? Do they have good backgrounds? Do they have good experience? Do they work well together, et cetera? The mission, right? What is driving you as a company, right? Are you, and this goes back to like understand your value and understand the value as a product and the value of your customers, right? Are you purely transactional? Are you just in here to say, we're here and we're a product and we're making money? Or are you here actually changing the lives of people in some way, shape, or form? And then risk reward, right? It's an analysis that every VC is going to do. Like what's the risk associated with it and what's the potential reward? So these are some things that VCs always look at. It's something that they're always going to consider these 4 points in them making investment. And there's a lot of subcategories along the lines too, but this is essentially high level, some of the things that they look at.
When you're pitching to VCs, is it important that the CEO must take the lead on that, or could it be just anyone from the founders who is maintaining this relationship from with the VCs from the first point of contact?
No, I mean, you can divide and conquer. If the founders are like, don't take a technical founder who doesn't understand VC or how to be able to sell and put him in front of an investor, right? You're going to blow your shot. But no, I mean, I think it's an equal distribution, generally speaking, across all the founders. Some again are stronger than others, understand who is strong where, but it may be that a technical founder who hasn't raised money before built a good relationship with a VC in their last venture and has the connection, right? And maybe they're the ones that should be leading the conversation in the beginning until kind of the CEO steps in.
Right. And if there is a founder who has built a solid product, solid team, but they fail to present it in a way they should, and then there is another founder who hasn't built a solid product or team, but he has been able to present it very well in front of VCs. He's been able to, sell himself really well. What are the chances of or likelihood of, one of these landing the investment? Obviously, it depends on the investors, but, generally speaking.
Yeah, it's a really good question. I mean, look, like you only get one first impression, right? I mean, you definitely got to consider that. It depends on the VC, depends on how busy they are. I've seen some that are, have the opportunity may be attractive enough for them to have a second and third conversation to kind of extract it out of you, you know what I'm saying, or give you like a second, third chance. But I mean, I don't want to say it's zero, but with every additional meeting that you need, you significantly reduce your opportunity to actually close, right? If you're spinning your wheels, if you're having a second meeting to go over what should have been in the first meeting, it's not really a good look.
Right. Thank you, Kareem. Let's move to the next slide.
Sure. I think this is the last one here. Okay, so valuation. I talked about data before, right? So defining a valuation and negotiating, right? So I see this all the time, right? TAM, SAM, SOM. Yes, we know the market opportunity is huge. And if you get 1% of this massive market, you will be a multi-billion dollar company. We get it. Okay, we understand that. But don't base unless you're really like late stage and you're actually coming into the market with a big mouth and you are like eating it up, right? Like, don't base your valuation on that like early on. Like, yes, you want to use that to show potential when you're early, right? But defining a valuation based off that, very, very hard, right? You can define a valuation based off of other commitments, right? Other people who have committed based off of a certain valuation. The most important thing is to substantiate your valuation, right? Like whether it's discounted cash flow, whether it's industry comps, again, data. It just has to be rational. It has to make sense, right? And it has to just be put together well. To have people look at it and try to poke holes in it, right? Whether if you have some early existing investors or if you have somebody who works in finance or something like that, try doing that, right? Try to anticipate the questions that a VC is going to ask. One of the other things is like the narrative, right? Like you have the opportunity to, if you're, for example, a company and what you're trying to do is you're trying to build a critical mass of users because you know that you're going to be able to monetize off those users, you can present that narrative, right? So let's say you're a company and the company is a SaaS company that helps people manage image portfolios, right? And what you can do is you can essentially create a narrative that says, okay, like it's a SaaS company and you can base the valuation off of monthly recurring revenue. But if you change the narrative to, well, we can create a marketplace where all of these images are being sold in a licensing model, right? And you can assign a small cent amount, literally like a few cents to each image, you can then create a much higher valuation for the company, right? If that's the strategy. So the narrative is very, very important. Try to think of control the narrative and think of, again, ways that it makes sense for you to be able to substantiate a valuation. On the negotiating, right? Like, how do you negotiate if you have alternative options, right? Somebody doesn't give you a good valuation, you can take a bridge round, right? To get to a little bit more money, to get a little bit farther along, to be able to get to a better, stronger valuation. Think about their interest, right, in your company, whether it's good for the portfolio, whether it's covering a blank spot in their portfolio. Whether it's an evolving or developing market, but versus your desperation, right? Don't present as if you're, you really need the money, right? And you're giving up your leverage at that point, right? Like, so you don't want to do that. So think more about like what is interesting for them. Why is it that they would want to come in here, and focus a little bit more on that and speak around that. Maximizing trust, right? The more that investors have confidence and are comfortable with you, the more that the more ammo you essentially have to be able to negotiate. If they trust you, that you're smart, that you're going to be able to get it done, then they're essentially thinking that it's, okay, it's not as risky as I normally invest in companies, right? And that may get them to be a little bit more comfortable with a better valuation. And maybe because they want to make sure that you have more economics so that you're better motivated, right? And again, negotiate value versus valuation. Like, what is the value of the company? What is, the asset value of the company? Not just the numbers and the valuation. Strong team, the problem that you're solving in the market, how this is going to change people's lives, right? Like, these things actually matter for VCs. They're not all, it's not 100% purely financial. It is a predominant focus and the primary focus of what they're looking at. But if that's 75%, like, that other 25% is really, really important for you to maximize, to be able to get a passing grade.
Thank you, Kareem. Very helpful. But if I'm trying to raise my first external investment as an early stage founder who has a product but doesn't have any traction, how do I reach a valuation? Is SAFE my only option to raise money? I cannot have a priced round?
You can have a price round, and some people do. I don't think it's in your best interest, though, right? What you want to do is you want to maintain as much optionality as possible. Like, I would recommend taking an instrument that has a valuation cap, which again is going to protect the investor, but it gives you the opportunity to really drive a very, very high valuation. Because once you set a valuation, like, you don't want to do a down round, right? You don't want to set like a, you don't want to give up a lot of equity. You don't want to do a down round in the future if it's too high, right? It's not going to be very attractive for your existing investors. They're going to take a haircut, for example. So again, like, I would try to maintain as much optionality as possible. Now, what is that valuation? How do you substantiate that valuation or a valuation cap? It's really just like, look at comparables, right? Look at other companies, look at what they're doing, look at what the industry standard is, and try to come up with with a valuation cap that you think is fair for you, so you have the right incentive, so you're not giving up as much, and so that the investor is happy and protected as well.
So the founders who have the network, who know a lot of people in the ecosystem, it is perhaps very easy for them to get these data points. But if somebody who is, trying to establish a company from scratch and doesn't know a lot of people in the ecosystem, how do they try to get these this type of data on, or comparables from some other companies, and how do they reach a valuation?
Yeah, so I think for them, if they're not involved in the ecosystem, they need to be, right? They can talk to other founders, they can talk to similar companies, they can talk to companies that are, they just go to Magnet and just look at companies that have recently raised X amount of dollars that you're looking to raise, right? And try to match them with your industry, right? And just reach out to the founders and be like, how did you go about it, right? And then also look at it's also from the investor's perspective too, right? Like, it all depends on the investor, right? You can set a valuation, but then you can be speaking to an investor who may give you a better valuation than what you were going to propose, right? So it also depends on the investor, and usually investor will come in and give you kind of like a baseline, right? But make sure that the investor is somebody who kind of, who's rational, logical, and really like understands, not, I'm going to take 70% of your company for $50,000.
Sure, absolutely. And do you think creating fear of missing out among investors actually works in favor of founders, or that's not the case in the Middle East, at least?
It does. I think that it's yes, I do think that it works. But again, you've got to be you have to be a pretty strong company, strong founder, right? If you're a strong founder, people are going to know, oh, whatever this guy touches is likely going to turn to gold. So I want to make sure I get in on his deals, right? Or the company progress itself, right? Oh, this company is actually doing really, really well. I want to be able to get in, right? So it definitely does work, but you need to have those, you need to have some of those elements to be able to do that.
And as an investor, how much importance do you pay to a letter of intent from another investor to a startup that is trying to raise from you as well?
I think it's, it's valuable. I think, so a letter of intent as in like they're soft committing the capital?
Yes, they write this down that, they are, for example, going to take part in this round, are not going to lead, but will be taking part in this round after, then the founder has arranged commitments from others to invest in the company.
Yeah, I mean, it's pretty strong. You know what I mean? It's usually, it's something it's validating, right? It's validating that other investors see the opportunity, and that they're willing to invest, they're willing to risk their money, and that also, they're going to be diversified, right? They're not going to be the only money in. It's very scary for an investor to kind of like double down or be the only money in on an investment.
Right. And you've raised your first external investment as using a safe. Is it still possible to go and raise more money using another safe, or once you've raised using a safe, that's it? You don't go and raise the next round also using a safe?
No, you absolutely can. I mean, you can
But
raise
generally
on it.
speaking, in terms of practice, is it practiced normally in the region?
It's very normal for you to see companies take money in on safe convertibles, KISS notes, all the way until they get to a price round, right? Like, which their Series A is got to be a price round, right? Lots of companies do that. It's recommended, right? You don't want to, unless you have a way to be able to substantiate a valuation. Try to do that. Try to get as much optionality as possible, and you absolutely can. They're usually a series of notes, so.
Right. And how do you substantiate the valuation? Okay, let's just say that it is a product with traction. It has revenue as well. Is it a revenue multiple here in the region, or do you look at other things? What do you look at as investors?
Yeah, it can be a revenue multiple. It can be a discounted cash flow. It can be, again, comparable. So there's several different methodologies that you can use, right? You can look at other emerging markets in like Latin America, right? Lots of similarities between emerging markets in the Middle East and LATAM. And you can say if this market was 100 million people and this is the TAM SAM of that market, right? And then, but here you can kind of back into what it would be and how you would apply it like locally in the region.
Right. Thank you, Kareem. I think we're done with the slides, right?
Yep.
Yeah. Thank you so much, everyone, for joining in who joined on Facebook. We're going to end this on Facebook now. And those who have joined us on Zoom, you will still have 15 to 20 minutes to ask any questions that you may have around venture capital for Kareem. For those on Facebook, we'll be back next week with another session as part of this bootcamp. Thank you so much, everyone, for joining in.
Thanks, everyone.
Okay, I think, yes, we have ended the stream, but just making sure. I'm just trying to make sure that we're not live on Facebook anymore, I think.
Sure.
Yes.
I don't see it in the
Okay.
top corner.
Yeah. Okay. So Amr has a question. Please go ahead, Amr. If you can
Okay.
first introduce yourself quickly and then, ask the question.
Yeah, okay. Thank you, Kareem. I have a question about when fundraising process, should I hire an accountant and a lawyer to come with me and see the term sheets, due diligence, and so on?
Yeah, so an accountant, depends on how good you keep your financial records. I think early on, if you're like early stage, I don't think you need an accountant. I don't think there's a lot there, but make sure that you maintain anything related to your OpEx, right? Make sure you just have good records and you take proper record keeping. A lawyer, I don't think you should bring them with you, right, to just talking with investors, but you definitely are going to need a lawyer to look over term sheets. You want to make sure that they are that you understand what the legal language is saying and what the effects or possible effects of the terms are. Usually in very early stage, you either have a convertible note, which consists of interest, a KISS note, which is no interest, and then also a safe note, right, which can or cannot have interest. And all of them have very same elements. They do some of the same things, so like a valuation cap, there's a discount, there's liquidity preference, and then there's like conversion mechanisms. So these are very complicated things. I definitely recommend making sure you have a lawyer look over all of them, and make sure that the lawyer is explaining all of the items in a way that you understand what the potential outcomes are. Does that answer your question?
I think he's on mute.
I think so. Okay. Yeah, he's on mute.
Yeah, it's okay. Thank you, Kareem.
Great, no problem.
I'm going to share a few more questions from the audience who have typed them in, but a quick follow-up on this. If somebody is raising a very small amount, let's just say $150,000 in the region, which is still, you know, it may not have been a very small amount like 2-3 years ago, but now considering the size of rounds and everything, it is a very small round. How much do you think is, you know, how much of this money? Okay, so they haven't raised money previously, but they need to pay the lawyers, and how much of this money could go to the lawyers? What is, you know, the amount that you think is fine, and beyond that would not be appropriate for a founder or for a startup to spend on a lawyer?
Yeah, I think it depends on the market, right? So $100,000 in Egypt is very different than $100,000 in the UAE, right? Right.
True.
Look, you want to make sure that you get somebody good, right? Somebody that's knowledgeable, that understands, but you don't want to overpay. I like, honestly, if you're talking about a convertible note, it doesn't take more than, you know, I would say like 5 or 6 hours for a lawyer to be able to, like, they're standard documents, right? And if it's somebody who's in the industry and they've dealt with them before, you know, you're not paying for his learning curve. He already understands it, right? So it's going to be that, you know, 4 or 5 hours at $200 an hour, $175 an hour. Like, you shouldn't need more than like $1,000.
Right. Okay. So Mustafa is asking, what kind of discounts should be offered to a team member who wants to invest in the company? I'm assuming he's talking about somebody who works at a startup and would like to invest in a startup, in this particular startup. What
That's
kind
a
of
very
discounts?
interesting. It's a very interesting question. You know, I would give them, you know, you give them like the best preferential terms that you gave to, like, the best terms that you gave to an investor. It's probably like a good baseline to go. That's all like relative, right? It's also relative about the individual, you know. Is it somebody who is going to be a core, is it like a rock star CTO, and you know that you need this high caliber CTO, so you want to incentivize him, so you can give him a bigger discount, for example, right? So it's kind of relative, but a good baseline to start with the best deal that you gave your most recent set of investors.
Right. Shiva is asking, how much dilution is good for a founder in seed stage for a B2C startup?
First seed stage, you probably don't want to give up more than like 15% of the company. You know, I think that's probably somewhere that's good. 15 to 20% maximum. You shouldn't try not to give up more than that.
Right. Mustafa again is asking, should the financial model be done by a certified entity, or it can be done internally?
Certified entity is going to cost you money. You need that level of, you need that level of skill to be able to put it together. I would recommend not a certified entity, but you definitely need somebody who is appropriate to be able to put that together. Somebody who knows how to put together a financial model and all the considerations. Definitely begin on your own. Because you're the one who runs the business, so you know what your expenses are going to be. Like, a financial person is just going to sit and ask you those questions and then put it in, right? So create something on your own that's very, very scrappy, so you eliminate a lot of the heavy work. And then what they will do is, after you've kind of like went over it 5, 6, 10 times, then bring somebody in who knows how to properly put it together. They will probably ask you and indicate things or illuminate things that you probably may have missed, or you didn't know, or you didn't consider, right? And then also we'll be able to implement some best practices, right? On being able to have those financial projections accurate.
Right. Shiva is asking, what is your view on fundraising for ride-sharing startups, especially when Uber is trying to reach profitability? What do VCs think of ride-sharing startups?
Look, they've gotten super hot, right? That's for sure. But again, ride sharing now is, remember when I was talking about like innovative edge? You need innovative edge now for ride sharing, right? Like that's what you need. So you see ride sharing for right now that is focused around specific segments, right? Like kids going to school, for corporations, right? So I think, you know, there is definitely room for VCs to be able to invest, but more likely you're going to need more of that like innovative edge, right? On the application or on the product, whether it's again a segment of the market or something being done differently. You're definitely going to need that to be able to get VC money.
Fahad is asking, how valuable are partnerships to investors? For example, if a digital consumer product company at early stage unlocks a partnership for distribution with a large telecom operator.
Sure. I mean, that gives you the ability to substantiate a valuation for your company, right? If you have a contract and it's a 5-year contract and that contract is worth, you know, $1 million a year, that's worth 5 million. Then what you can do is you can essentially say, you can base, right? Remember, it's substantiating your valuation. You can base and say, okay, we know that this contract took us a year to get. The next one is going to take us 10 months to get, and so on and so forth. So it is extremely valuable. And it's also, it's validation, right? It's validation that somebody would pay and people in the market would actually pay for your product or service. So it's very strong.
And what if the partnerships don't have any monetary value attached to them? So they're a partnership that could help me get more users who could potentially pay or not pay for the products that I'm trying to sell, but the partnership itself does not have any, you know, monetary value attached to it.
Could be extremely valuable. Again, it depends on your business. If you are, you know, if you're targeting, moms, for your product targets moms, for example, and you partner with one of the biggest, you know, house cleaning companies in the region, you know, they're going to have a database of like, you know, hundreds of thousands of moms, for example, right? So that's extremely valuable. So it depends on how relative the value added of the partnership, or what the benefit that you would get from the partnership, how much value added that would be to your core business.
And the VCs actually think that these partnerships could be valuable to startups that are trying to do that.
Yeah, 100%. But again, it's going to be relative, right? If it's small partnership, or if it's small, if you say we're going to get access to this database, but it's 20,000 people, that's different from saying we're going to get access to this database that's like 200, 300,000 people.
Right. Okay. Amr is asking advantages and disadvantages of angel investors at pre-seed stage. By pre-seed, I'm assuming he's trying to say when you don't have the product ready.
Yeah, it's valuable if you obviously need the money to be able to build, but most of the time, what you find, I think we discussed a little bit about this in the first session, is the angel investors are probably going to be somebody who understands the industry and understands the industry and understands the value that you're trying to create in the industry, right? So that's a very big advantage, right? Somebody who has the industry knowledge, the access, maybe the ability to mobilize some other investors, very, very big advantage. What is a disadvantage? That angel investor may be somebody who's going to want to be hyperactive in the business, and that might be, again, very problematic for you. Somebody who's going to make noise, somebody who you're going to have to handle or manage, right? So that can also be a disadvantage. So I think that's the only real disadvantage of coming in with an angel investor is their level of engagement with you and whether that's going to be beneficial for you or not.
Right. I think we're almost done with questions. If any one of you has asked something that hasn't been answered, please raise your hand and we'll give you the access to microphone. Kareem, okay, Mustafa. Go ahead, Mustafa.
No, guys, sorry for asking too many questions this session.
No, please go ahead.
No,
This
bring it on.
this session is, yeah, like we said in the beginning, primarily for you guys and then for those who are watching on Facebook.
Thanks a lot. So in Bird Nest, we had a meeting with a VC who really liked the concept, but he was thinking of the exit, and he told us that we need to do the financial model, expecting $100 million in revenues within 5 years, so he can so we can be able to exit it in 5 years. So we built the model around it, and it seems very, very optimistic, and it requires a lot of cash. So before, I'm asking for feedback before sending it out to know, could it be like a challenge from him to see what is our maximum capacity, or is it we should be optimistic and this is the scale of we should go
and Mustafa, if you can quickly tell Kareem about what Bird Nest does. I'm not sure if you remember. Okay, you remember.
No,
okay.
I remember.
Yeah, I emailed
okay.
that. Thank you.
Perfect. Okay.
Yeah.
Perfect.
So they may be testing you. They may be testing you to think of like your ideas and what would be your strategy. So it may be that, but don't I would be cautious about letting an investor drive your business, right? You know, an investor coming in and asking you to get on this track, right? To put this track together and then get on it, is something that I would think about very, very heavily, right? Especially if it's something that to you feels overly optimistic, right? Under promise, over deliver. How would you respond? You know, I would respond by showing, okay, here's a model. This is, and just tell them, be transparent, be like, we think that this is, you know, a little overzealous. It's overly optimistic. We think that we would struggle. And we also think that there are many other options and 3 or 4 different ways to be able to achieve that. And that we can't really predict 5 years down the road because we don't have statistically relevant data, or we can't really substantiate that, right? So just be transparent with them and identify all of those things.
Thank you.
Sure, no problem.
Thank you, Mustafa. There is another one from Shiva. If you were to invest your next $1 million, where would you invest? You're already in process of investing that.
Yeah.
How many investments you guys have made that haven't been announced yet?
Oh, there's a few. There's a couple of them. Yeah. But we'll start dripping them out soon. The next 1 million. Look, I think cybersecurity is going to be huge. Think about COVID, right? Like everybody's working from home, and I think that there's going to be a fundamental shift in how businesses think about, do I need to actually have an office all the time, right? I don't want to say an office like zero sum. Like, yes, every business is going to need to have an office, but if they can reduce their office size because people are rotating in and out and there's an easier work from home policy, people are going to be working remote. And a lot of these large corporates do not have the infrastructure, the technical infrastructure to allow all of their employees to work from home in a safe way. So think about it. If you're a corporation and you have 2,000 employees, sure, your IT department has senior management, their BlackBerries and their iPhones and their laptops all set up for them to be able to work from all over the world because these guys travel all the time, but they definitely don't have it for all their employees, right? And this is going to create a huge vulnerability. There's going to be a lot of vulnerability, especially for big companies, right? That aren't lean enough and have a big number of people to be able to implement this type of organizational change, to be able to pivot to that. So I think there's going to be a lot of, I think that like cybersecurity from a thinking about protecting business data standpoint is going to be super, super critical. So for me, I think that's something that's here to stay, and that's definitely a bet that I would make.
Right. I think Mustafa has another question. Mustafa, please go ahead if you have a question.
No, don't have any questions. So
okay, that was from the previous one. All right. Okay.
Yeah.
Thank you. Amr, you have a question?
Yes.
Yeah, go ahead.
Okay. Kareem, how do you see and evaluate startups coming from competitions and grants? They always enrolled in a lot of competition because some VCs don't accept these kind of entrepreneurs who are seeking any competitions they are encountered?
Yeah, look, like I have a personal opinion about this, right? I'm sharing this to the group. Like competition is not winning competitions and entering and getting accepted to competitions is not a metric for success, right? The other thing, like at all, right? But I can understand somebody, a company that goes in because they need to win it for funding, right? If they're doing it for credibility, like I think it has a very, very low value, right? Unless you're talking about Y Combinator, but again, those are like programs, right? Those aren't competitions, right? It's not, you get on a stage and you get something shiny and you get a check for like 10,000 Egyptian pounds. But again, it may be again that the entrepreneur is just trying to find whatever opportunities they have to be able to get small checks, right? To continue the business. It also may be that the entrepreneur is doing this as a strategy to get in front of potential investors, right? So it's what does it say about the startup? Like I wouldn't base any value off of it, but I wouldn't penalize a startup for doing it, right? Because they may have very clear, legitimate reasons for being able to do it, and there's nothing wrong with that. So does that answer your question?
Yes. Okay. Thank you, Kareem.
Yep, sure.
Thank you, Amr. Shiva, you have a question?
Yes. Hi, can you hear me?
Hey,
Yes.
Okay. Hi, Kareem. Shiva here. So I run a ride-sharing startup called Hubun, dedicated to women and kids, only similar to Zoom and Hop, Skip, and Drive in California, right? So my question is very related to the valuation method called sum of total parts, SOTP, right? So we are trying to raise money, and I'm trying to get into multiple. Dubai is a very peculiar market in terms of how do you want to get the cars onto your network, and only limousine companies can. I'm sure you're aware of what I'm talking about, right? So if we were to invest in a limousine company, then and everything comes out of the holding company, which is where the investor would come in and invest, right? So there's a separate operating entity for the ride sharing. There's a separate company for limousine. There is a separate, and we want to get in. Let's say we want to get into software as a business, software as a service, which is a separate thing where we want to let go. We want to reuse the software. And if the investor and everything comes out of the holding entity, which is, let's say, it's in Singapore or wherever it is, right? So every company has a different valuation, right? Of their own valuation of their own, though it's all coming from the same holding company. So which means if the investor is coming at the holding company level, then we're using a methodology called sum of total parts.
Yep.
Right. Do VCs like this method? Like, let's say right now it's a large guy who's got a lot of money, wants to put in, let's say, $10 million, right? But in the next round, when I want to raise a lot more money, he can't afford it, then I have to go to VCs, right? Do VCs like this kind of an arrangement, or would they prefer separate? Question number one. Question number two is, tomorrow, if I were to sell only one part of the business to somebody else, or if I were to spin off something else to somebody else, how would this work? And are we complicating it too much at such an early stage?
So first, I think you're probably complicating it too much at an early stage. I mean, I don't know how early you are, but I would be cautious of that. Right. Second, as a strategy, like I totally understand it. I would be very cautious of having any one of these entities be if you're going to be buying limousines, right? Like that's a depreciating asset. So you got to remember that, right? That's not something that's going to be, investors are going to see that and say, this is a depreciating asset, 100%. So you have to understand its relevance as far as value added to the rest of the business, right? So that's really important. And then if you raise at the holding company level, like most investors, so there's going to be two things. One is investors may want to say, I don't want this asset. I don't want this subsidiary asset, right? If it's a depreciating asset and it's ownership of vehicles, for example, they may want to carve that out, and you may get that, right? And the more sub entities that you have, the more you're likely going to run into that type of a situation. So I would be cautious about that. And then if it was part of the holding company and you wanted to spin out just one part of it, you're going to have to, essentially going to have to either buy out its percentage stake from the holding company, right? Or have investors be able to buy that out. So there's going to have to be some sort of liquidation that goes to the holding company, because the holding company is going to have investors, and those investors own X% of that sub, right? So that's going to have to go back up the chain. Does that answer your question?
Yeah. So we have to go back and we'll have to do a weighted average, or that's how we do the SOTP valuation at the holding level, right? But I think you've answered. I think more or less we are complicating it too much, and they're all completely different business models. Some investors might want to come only for a certain business and not for everything. So we're thinking through this whole thing and trying to how to figure this out. Yeah. Anyway, thanks, Kareem.
Yeah, no problem. No problem.
Thank you, Shiva. So the last question of the day is going to be from Please go ahead,
Okay, Kareem, should I register my company outside Egypt before fundraising, or right raising in the milestone?
That's a good question. Are you raising from investors in Egypt, like local
No.
investors in Egypt?
No, from GCC.
Yeah, so definitely going to want to register an entity outside of Egypt. So Egypt doesn't have very sophisticated ownership laws that are tailored to venture investing that gives investors protection in a way that they are going to want to understand. Even the investors in the GCC, they're probably going to want you to register in Malta, in the US, or in Cayman, some jurisdiction that is enforceable and that protects the investor. So I would definitely consider setting up in an outside jurisdiction, 100%.
Okay, shukran, Kareem.
Sure.
Right. Thank you so much, everyone, for joining in and attending this second session. We'll be back next week with the third session. If you have any questions that you would like to ask Kareem, anything around venture capital, you again will be given this chance to ask your questions in the last 30 minutes of the third session. And also there is this group that Salama has just posted on the chat, and some of you have already joined it. You can also share your questions in that group. And obviously, if there is something that you wouldn't like to share publicly, Kareem will try to see if he can also, answer some of your questions over email as well. So feel free to reach out to him on email too, if you like. Thank you so much, everyone, for joining in. Thank you so much, Kareem, for taking the time again to do this, and see you next week.
Thanks, everyone. See you guys next week.
Thank you.
Take care.